So we're having this presentation today for launching our financial planning services. Thank you so much for joining. We really appreciate you taking the time. So I'm Suruchi Jain, Managing Director and Founder of Opportune Wealth Advisors, and I have my team here as well. I'll be calling out their names towards the end of the presentation. So a quick look, what made me start this business was actually back in 2011, I met Buffett through an MBA tour. So I was one of the 20 people selected from University of Chicago, where I was doing my MBA, to go and meet Buffett. And prior to that, I was actually looking to do a venture capital career. And after I met him, I realized that equity investing is in my blood. My dad had already been doing it for more than 20 years. And I had imbibed all the so-called, subtle, intangible ways to look at businesses, even while I didn't know it. And, when I met Buffett, I just realized that that was the thing that I should do versus venture capital. So a famous quote by Buffett is that if you don't find a way to make money while you sleep, you will work until you die. And so that is my motto in terms of allowing our clients to build their wealth over time and, retire early, hopefully. And even if not retire early, then retire very comfortably. So our mission is to help clients gain equity exposure and experience the compounding of wealth over time. And this is through a sound research philosophy, which I'll also detail later in the presentation, with a minimum 5-year outlook on any company that we invest in. So our churn rate is really low. We are invested in some of our companies from the start of our business, which is in 2016 is when we started investing. And so the average holding period right now is about 3 years. For a company that's just 4 years old, that just gives you an idea of the low churn in our portfolio. We always are very transparent in all our dealings. There are no hidden charges. Everything's very upfront. And the founders, that's me and my father, Ajay Jain, we both invest alongside the investors. And we plan to be in business for the next 30 years. So just two quick look at dates. We were incorporated on 3rd May 2016 and investing since September 2016. So when I speak about long-term returns, we'll be talking about all returns since September 2016. So what are the products we offer? So initially we only offered the first two, and today we're starting to offer the last, which is financial planning on goals like house purchase, child education, and others. And we think that the financial planning is very closely linked to the first two, because essentially you're trying to get to number 3 by investing in 1 or 2. So one is equity portfolios and second is mutual fund advisory. I'll come to how we go about it in a few slides. But just to talk about our main product, equity investing. What we're offering here is essentially we're looking to compound your money, basically double it every 5 years. And what that means is our target is to get like a 15.6% return for our clients. And this compounding only needs time and patience, right? And a set process. So that is what we at Opportune Wealth had set our targets as. That, say a 25 lakh portfolio, we want to take it to a 50 lakh portfolio, right? And in 30 years, which is like a time horizon that someone usually has, like a young person who might have that kind of a time horizon, to take 25 lakhs to say a 19.3 crore value, because they're doubling every 5 years and they're not touching that money, right? If you keep going in and out, then you're subject to market returns in the short run. But if you stay invested and, stick with us for 30 years, I think you could retire with the portfolio that you have with Opportune Wealth. Markets are not linear. I think those of us who've been around investing for long enough would know that. So you have to be able to stomach the spicy dish before you order it. So we have had clients who couldn't stomach it and who have left at the bottom, but then they haven't done themselves a huge favor, right? Because you're booking a loss and going. Otherwise, everything's unrealized loss or unrealized gain until you actually sell it at retirement. So for those who have that kind of patience, equities is the product for you. And you can see, if you put in a debt mutual fund, where would you have been? So this is 100 rupees basically put in back in 1999, and what they would have been in 20 years if you had just put it in the Nifty 50 or in the debt, an SBI debt mutual fund or a fixed deposit. So debt mutual fund gives you a tax advantage versus say a FD, which is fully taxable beyond 1.5 lakhs. And equity until 2018 was actually completely tax-free. And now, even though it does have 10% long-term capital gains, it's still, from a tax perspective, also the highest wealth creator, the best wealth creator. Just a sec, my page is not moving. Yes. So, talking about the financial planning bit, the financial planning is what helps you stomach the spicy dish of equities, right? Once you have this, and what is this? This is basically a goals pyramid. What it talks about is when you first start working, right? And you're just at the start of your financial independence. You first start fulfilling your needs. You have your living expenses, rent. You want to buy a house. You want to educate your kids, or maybe you want to go for higher education. You want to get the best healthcare. So if you have a health problem, you want to go to the best doctor. You want to have transport, so you want to buy a car. You want to have enough insurance, and you want to be able to service your taxes, right? Slowly, as you start working for another 10 years, 15 years, you move to wants. Your basic needs are met. And so this is like the pyramid of wealth creation. So slowly you go to wants, and you want a better house, a better education for your kids, comfortable retirement. You want that international vacation, you want a better car, and you want career growth. And most of us, I think, go beyond the needs and wants in our working life, which is when we go to dreams, where you want to travel the world, right? Not just go on a vacation, but you want to take 3 months, 4 months off. You want to do some community work, you want to do some charity, you want financial freedom, you want to take up that hobby that you never had the time to do, and now you have the time and the money, right? And then the only purpose money has really is either you consume it through your needs, wants, and dreams in your lifetime, or then you leave it behind for your kids. So that is when you conserve the capital, right? And you build a legacy for your kids, your grandkids, and you leave money behind. So through the financial goal planning, what we are hoping is to give you that patience to stay with the equity investing, continue to build your capital, continue to put in more and more money, and, go all the way till your legacy, where you save even beyond what you need in your lifetime, but actually save for the next generation as well. So quick look at our products and fees. Like I said, we're very transparent about what we offer and what we charge. So in the direct equity portfolios, Opportune invests alongside you, right? That's both me and my dad, and a lot of our employees are also investing in the same stocks. We have a fees of 2.5% per annum. It's a flat fee structure so that there's no confusion. You can even take a piece of paper and calculate it. You can take out your phone and calculate it. It's really simple. The minimum ticket size that we have raised now is minimum of 25 lakhs, right? And we have a demat. We usually prefer a demat with Motilal Oswal only because we have a tie-up with them, while we don't earn any brokerage from them. But there are clients recently who have taken up other service providers. The only thing is that they have to trade on their own. So we would just provide you the recommendations if you have a non-Motilal Oswal account, and you would be responsible for executing those trades and sending us your contract notes. So our current equity portfolio has about 25% financial services, 22% technology, 21% pharma healthcare, and 15% banks, and 10% chemicals. That's the rough breakup of what we've invested for clients. We also have some amount of cash, but that's usually not more than say 5 to 6% on average. Mutual funds, right? We are offering both direct and the indirect method, which is where we would make a distribution fee. But of course, if you're looking just for direct mutual funds, we're happy to create that portfolio for you and charge you like an advisory fee if you have like a large portfolio that you'd like us to manage for you and track. The main thing I think people forget when they do the whole do-it-yourself is that all these investments really require a lot of tracking. Most people who are very busy professionals, they don't get time to track it on a daily basis. And whenever they see their investments, if it's down, they end up selling, not realizing like that 6 months down the line, that money will probably be in the green again. So that's where we come in, where we are tracking it. We're sending you quarterly reports, And that's where, the advisory fee, in my opinion, and this is not the barber telling you need a haircut, but really it's been beneficial. So for the number of clients that have maybe left us that, oh, we don't want to pay fees, their fees has been more than recuperated, since the pandemic and beyond. So they would have made 10x the profits of the fees that they paid us. So I think that's just a perspective, right? And if you were trying to manage your funds on your own, we've luckily had that data. So the gap in that performance is also more than 5%, right? So if we've got 15%, say a client who maybe left us a year or two ago has only made 9%. So would you rather, have like higher returns, or, be stingy on the fees? Okay, so going into our new product offering, which is financial planning, essentially, I mentioned, it's for goals like house purchase, child education, and retirement. We would be having like a fixed fee model for this. This, of course, would really depend on client to client needs and what someone might need. Talking about returns, right? So PMS Bazaar is an aggregator of portfolio management schemes. So we consider ourselves a competitor to portfolio management schemes since we have a concentrated portfolio. And so we invested in about 10 to 18 stocks in our portfolio. And when you look at the December results, you can see that, we're in the top 10 of the PMS returns, right? This is on a 3-year average basis. And so we have far outperformed most of the portfolio managers. And so we're really happy to report that. So how do we do this, right? So most portfolios, which are mutual fund oriented, they're trying to give you diversification benefits. And they hold about 70 to 80 stocks. And these are equity mutual funds, which are looking to give you like a broad-based equity exposure. The maximum they can hold in a particular company is 10%. But honestly, because they're holding public money and they're holding thousands of crores, they mostly end up hugging the benchmark. When I say hugging the benchmark, it means that 80% of the money that mutual funds manage is all held in the Bombay stock, in the BSE Sensex 30 stocks or in the Nifty 50 stocks. So if you see, only the balance 20% is what they are trying to, outperform with. And the 80% is just basically held in benchmark, because on a quarterly or a monthly basis, this data is openly published. So the safest thing for them to do is to closely reflect the benchmark. And now with a lot of index funds coming in, what index funds do is hold exactly the Nifty 50 if it's a Nifty 50 ETF, and the Sensex, if it's a Sensex ETF, then they're holding exactly what the Sensex holds. So there will be a very small difference between a mutual fund and the Nifty 50 or the Sensex, if you decide to hold that. So this is where Opportune Wealth wins, where we have a multi-cap portfolio and it's a concentrated portfolio. So we have 10 to 18 stocks which are in detail researched, and they don't necessarily have to be in the Nifty 50 or in the Sensex, or they don't even need to be in a mutual fund's top investment list. So we do our own research, and I'll come to that slowly on how we go about it. So a lot of people who end up, the do-it-yourself investing, they look backwards. They look at, okay, which stock has moved a lot, and maybe this is the stock to buy. This is the stock that moves, up or down really, really quickly. And so this is the one I want to get in and get out quickly. And usually what it does is it ends up in a crash, right? It leads to accidents because you're investing looking backwards. And the whole point is that you have to always invest looking forwards. And I'll explain that with an example where you have to essentially predict that, okay, what will happen going forward, not with the price, but actually with the industry. So just give you a quick example of how people usually end up investing, right? Like Maruti. People are so stock. Sorry, please mute yourself. So Maruti is one stock, which is very famous for traders and the do-it-yourself investor. So they would buy it at a low and then again sell it and then again buy it and then again sell it. See, this actually, the automotive sector, and which I'll also explain in more detail, is a very cyclical, not only from a share price perspective, but also from the underlying dynamics of profitability and demand cycles. So a lot of things go in to the automotive sector. And if someone's just looking at the price, they're actually going to get it all wrong. So on the other hand, if someone says, okay, I want to invest in Hindustan Unilever, but you want to get in and get out quickly, it's not really possible, right? You want to invest because it's a slow growth mover. And if you're, again, looking backwards that, oh no, it's at 100p or it's at a 50p. If you're just looking at the price, you'll always get it wrong. You either will never enter, or if you enter, you'll sell it when it gets even more expensive. So at Opportune Wealth, what's our research methodology? We basically look at a 4-pronged strategy. We look at select industries. We look at winning companies within that select industries. We look for sound management. And lastly, we look at fair valuations. So in fact, we don't even look at the share price before we've done the first 3 things. So it's quite the opposite of what a normal investor would do. That, hey, like Maruti's at 4,000, should I buy it? I think it'll go to 7,000. But that's not how we invest. We basically look at, is this the right industry? And then we look at, okay, which company within that industry? And we're looking at industry dynamics. What will happen 10 years out? What will happen 20 years out? And that's where I mean by, okay, we look through the windshield when we're driving and when we're investing, not through the rearview mirror. Because if you look through the rearview mirror, all you see is the share price. You won't really see what's going to happen next. So let me talk a little bit more about the industry. So coming to transport, right? If I just see like a timeline, back in the 1940s, the most common transport was obviously a horse-drawn carriage. And in 1960s, I would say, the cycle was around for everyone to transport themselves. In the 1980s, especially in India, I think it was the motorbike. And, shortly after 1990s or so onwards, the car steadily gained traction. And so in year 2000, you'd say quite a few people had a car. And in 2030, what's next? It's probably an electric vehicle, right? But you can see that this industry has gone through so many shifts, and there would have been so many companies, essentially between the cycle and the car, and now the car and the electric vehicle. The number of parts that go in, the number of manufacturers, the number of people is many, and it's difficult to predict. If you don't know what's going to happen in the industry, then how will you predict even who's going to win, right? Let me take another example. Soaps were there in 1940s. They were there in 1960s, 1980s, 2000, 2013, right? I mean, I'm pretty sure all of us will still have a bath every day. So it's a very simple industry to understand. Most of investing is as simple as a soap bar. It's essentially that a company, say like Hindustan Unilever, is going to make more money because it's either able to sell more soap, so more quantity, or sell it at a higher price because they've done some branding and they've premiumized their product. Similarly with paints, right? Paints were there in 1940s. They were there in 1980s. They're going to be there in 2030. So maybe, yeah, the pigments will change, the variety will change, and the number of colors you have will change. But essentially, it's the same product. So investing is actually quite boring compared to, the excitement that most people try to find in predicting that, oh, like I knew that electric vehicles will do well, and so I picked this company and look what's happened, right? For us at Opportune, we're not trying to be the smartest. We're just trying to be the simplest, and we're just trying to see whether we can predict what will happen in the next 10 years, 20 years, 30 years. So here are the industries we like, and here are the ones that we avoid. So in terms of avoiding, we basically avoid asset heavy companies, high capex companies, and slow growth companies. Some of the sectors which are in our, do not enter and avoid list are oil and gas, cement, power, automobiles. Whereas the ones that we do like and are invested in currently as well are asset light companies, with strong cash flows, high growth. And some of these are financial services, pharmaceuticals, FMCG, and technology, right? These are also the industries that we understand. There's nothing wrong if someone understands the automobiles, segment better and they do automobile investing. But we just think that's not for us. Like, we have invested in Maruti in the past. We did see the price go from 6,000 to 9,000, but no, we couldn't exit at 9,000. So I think, we would rather hold something which shows us compounding in the long run, and we don't have to constantly wonder where will the stock price go and where will the earnings go. So again, one more comparison of our portfolio performance. Over the last 4 years, we've been able to compound, like I mentioned, at 15.7%. And if you see, compared to the Nifty 50 or the BSE 500, right, there's a significant outperformance. So you see any time period, 4 years, it's 15, and compared to 14 and 13. A 3-year, like I said, was a 12.5%, which is, we were in the top 10 portfolio managers as reported by PMS Bazaar, because most of that data is not there in the public domain, whereas this data is there in the public domain. So in 3 years, we've been able to outperform both the BSE 500 and the Nifty 50. And of course, the 1-year returns and the 2-year returns are even more better. And in the last 6 months, we were able to do 45% versus the Nifty 50 of 36 and 36, right? But this is not what I can promise you. We can promise, rather not even promise you, and we don't make any guarantees. But in all likelihood, if you do all the processes right, then in a 4, 5, 10, 20-year horizon, one can be here. Like we said, we've achieved this in 4 years, which is outstanding compared to the 5 years which we were expecting it to happen in. So again, this is our research methodology, industry, company management, and valuations. And let me quickly talk to you about us before I wrap up. So Opportune Wealth Advisors now offers 3 services. We have a license for all these 3. A quick look at my background. So my first job was at Monitor Group as a consultant, and I was able to help companies grow their businesses, decide on pricing strategies, sales strategies for oil and gas companies, motorcycle companies, FMCG companies, confectionery companies. So that actually, my experience at Monitor Group gave me a very vast look into many companies and industries. After that, I went to Chicago Booth to do my MBA because I wanted to move into finance. And actually, I wanted to move into venture capital back then. So I also did a Hyde Park Angels internship for a year. And I was going to move into venture capital until I met Buffett. And so in 2011, just 3 months before I was graduating from business school, I met Buffett, and I realized that I was meant to do equity investing instead of venture capital. And so then I gave up the venture capital job that I had secured and came back to India and joined Morningstar as an equity research analyst. And in the 4 years I was at Morningstar, alongside getting a lot of my research calls right at the company, I was also able to double my own personal wealth in 4 years. And I'm happy to report that even at Opportune Wealth in 4 years, we have been able to double for our clients as well. And so Opportune Wealth was born in 2016 when I decided to leave Morningstar and help clients also achieve what I had achieved for myself. Who we are, the organization structure, right? We have currently 3 employees. And so I am the main point of contact for clients, and I would help them do the financial planning and advisory. We have 2 separate divisions for mutual funds and equity advisory. So the equity research mostly sits under the equity advisory piece, and the operations is, of course, goes across both mutual funds and equity advisory. I have all 3, Shivam, Simran, and Anuja, on the call today. And before the pandemic, this was our office. We still have this space, but unfortunately, because all my employees live very far away, we haven't currently been able to resume work from here. We have been working virtually and not missed a single day. So this is very close to my house. So Bootstart Co-work Kulaba, I am definitely there in office, and if you decide to drop by, I'd be happy to meet you. My employees are working from home, but I'd be happy to come and meet you, at the Bootstart Kulaba. So do let me know if you'd like to drop by and we can meet up. Just a quick look at how to become a client. We essentially do a risk profiling. of each client to understand their risk tolerance towards equity. So we have actually even refused to take people on board because they were thinking FD returns and they were asking us how much can we get in a year. And honestly, we can't promise you how much you can get. You could even get negative returns in a year because 1 year is too short a time horizon for equity investing. We then have you sign a client agreement, and then we do a client KYC, and then we need a personal demat. So the personal demat, usually if you want us to execute, is with Motilal Oswal because they have a really good technology platform which allows us to monitor all your holdings and sell them like at a really quick pace. And we do have discounted rates of brokerage with Motilal Oswal set up for our clients. Since Opportune Wealth does not take any brokerage from them, we only earn from the advisory fee that you give us. And the special account features, in the sense, what we are offering is portfolio allocation, monitoring, quarterly reports, and at a cost of 2.5% per annum advisory fee. And so we work a lot like a portfolio management service. If any of you have already tried a portfolio management service scheme, and all charges and everything would be mentioned in your quarterly report. And we're always here if you need a more frequent holding report and anything that you need for your tax filings and everything. With that, just a quick look at our disclaimers. We do hold investments in some of the stocks that may have been mentioned or the industries that would have been mentioned. And with that, I wrap my presentation. We have updated our website recently. Please do check it out. It's opportunewealth.com. Any questions, then I'd be happy to take them.